Hey guys, hope you're doing well out there. Today, we're taking a look at two companies in the financial services industry that were requested here on the channel. The first one being Moody's Corporation, ticker symbol MCO, and we'll also be taking a look at MSCI Incorporated. Both of these financial services giants are very, very high quality companies. Now, this video, think of it more so as a part 2 to a video we did last week here on the channel where we took a look at S&P Global stock. So if you haven't got a chance to check out that video, I will have that linked in the description. Be sure to check that one out, because as we go over Moody's and MSCI today, you'll see a lot of overlapping business models, a lot of overlapping business segments, I should rather say, that these companies have. And so we'll be referring to S&P Global and really have a little bit of a comparison to how these companies hold up against S&P Global. Again, we looked at that company more so in depth last week, so be sure to check that video out. Now, as always, if you are new to the channel and find this type of content valuable, the one thing I ask from you is to hit that subscribe button below. It would be much appreciated. Let's jump into Moody's Corporation, ticker symbol MCO. This is close to a $480 stock, nearly a $90 billion company. One thing to notice is you get a forward yield on this, 0.71, very similar to S&P Global. It's not a huge yield to start off with, but again, one of those companies that consistently grows that dividend. You're also looking at a profitable company closer to a 40, if not 35 times a forward earnings multiple. So you are trading relatively expensive on this quality company. Now, year to date, over the past 1 year, you've seen shares appreciate nicely, up close to 28%. Now, the question is, can that performance for this company continue over the next couple of years? Now, the first thing I want to talk about is what Moody's Corporation does, a little high level overview of their different business segments. So they basically have two business segments, the first one being Moody's Analytics and the second one being Moody's Investor Services. So let's first take a look at what the Moody's Analytics segment really does. They develop a range of products and services that support risk management activities for institutional participants in the financial market. So like again, I said last week, we took a look at S&P Global and they have a market intelligence segment that we dove deeply into. They also have a commodity insights, which is very similar to the market intelligence, just more so for the commodities business. They also have that mobility segment, which again, very similar to an analytics segment, specifically for the auto value chain. Now, I would say Moody's Analytics is very, very similar to that S&P Global market intelligence segment. They provide credit research, credit models, analytics, economics data, models, all sorts of different financial solutions and data sets that companies and other securities, governments, maybe banks and insurance companies can use to make better decisions, maybe to mitigate risk or maybe to understand when to take out credit and those sorts of things. So the analytics segment is the first part that makes up Moody's business. The other part is Moody's Investor Service segment. This is the larger part of this company's business, and that publishes credit ratings and provides assessment services on various debt obligations, programs, facilities, and those sorts of things. And again, they also provide structured finance securities. So very, very similar to S&P Global's ratings business. This is basically Moody's version of their credit rating service, or credit ratings business, I should say, that is known as Moody's Investor Service. Again, this makes up the majority of this company's revenue. It is the larger of the two business segments over at Moody's. So we'll jump a little bit more into each of those business units. But one thing I do want to mention is how strong of a dividend growth company Moody's really is. They've been paying out dividends for 24 years, and they've been growing that dividend for over the past 15 years. So you're getting very consistent dividend growth, and you can probably continue to expect that over the next couple of years. This is not nearly as strong as S&P Global's 50 years of dividend growth, but I'm sure Moody's at some point will be trying to get there. I think you can absolutely continue to expect dividend growth with this one without any issues. Now, another piece of news that did come out from Moody's right around a couple months ago was that they were acquiring the loan origination platform Numerated Growth. Now, this is expected to expand the company's lending suite capabilities, so I think it'll go more so in investor services segment, and it'll partner up with Moody's credit assessments, underwriting, monitoring, expertise, and those sorts of things. So the terms of the transaction were not disclosed, but what this really tells me is companies like Moody's will continue to do small tuck-in acquisitions. They'll continue to tack on a little bit of inorganic growth as they continue to still grow organically. But these companies tend to pick up and acquire smaller companies that can really be an add-on or beneficial for their existing suite of platforms. It's also one way to protect their moat, as they're certainly in the financial position to begin and continue to acquire smaller companies that enter this space. Now, Moody's did raise their 2024 profit outlook as their Q3 results exceeded consensus. We saw this when we took a look at S&P Global last week. They also raised guidance both on the revenue side, on the earnings side as well, as Q3 came in stronger than expected. So you're not just seeing that with S&P Global, you're seeing it really across the financial services industry. Moody's again coming in with a higher expected guidance, raising that outlook as closing out 2024 is looking to be pretty strong for these companies. Now, let's first take a look at the Moody's Analytics segment. This is a business segment growing 7% year over year, at least in their most recent Q3. One thing I do want to point out is that you saw adjusted operating margins decline in this business unit, roughly 330 basis points year over year. So last year you were at closer to 33.6% adjusted operating margins. Now that's down to just over 30% operating margins. Now, what I want to do is compare that to S&P Global's market intelligence segment. This is again their largest analytics segment, very similar to Moody's Analytics, I would say. So you're expecting, you saw 6% revenue growth. That compares quite favorably to Moody's, which saw 7% revenue growth. And then you're seeing adjusted operating margins closer to 33%, which actually went higher year over year for S&P Global. So that's one little bit concerning of a data point for me for Moody's, is the fact that you're seeing those operating margins year over year declining, whereas with S&P Global, you actually saw those adjusted operating margins tick up on a year over year basis. So maybe this could be a one-time thing. I would be paying attention to the adjusted operating margins on the analytics segment. You wouldn't want to see this continuing to go down, especially when peers and competitors like S&P Global are raising their adjusted operating margin on the same quarter. Now, the other thing I do want to point out with the analytics segment is it's a very, very recurring revenue dependent business model. So they have nearly $3.1 billion in annual recurring revenue. And what I want to point out is that is growing at nearly 9%. So you're growing your total revenues in this segment by 7% year over year, but you're growing your recurring revenue by nearly 9%. So for every dollar that you're bringing in on the revenue side, more and more of that is contributing to your annual recurring revenue. And certainly we do like recurring revenue. It's more predictable. It's also probably higher margin. And so that's certainly good to see more and more of that revenue is becoming annual recurring revenue. And the other thing with recurring revenue is it relies on customers that continue to stick around. Now, the good thing for Moody's is that they have a retention base of nearly 93%. Yeah, that's right, 93% retention rate for this business. That's in line with some great companies we look at. We look at Costco's membership business model with a renewal rate of, I believe, 92 or 93%. This is really in line with that, and that's a very, very solid retention rate, again, for an annual recurring revenue. That is exciting to see. That's still growing year over year. The other last thing I want to point out with the analytics business, it is ultra predictable. Yeah, that's right. Over the last 9 quarters, you've seen revenue continuously grow every single quarter over quarter. Even when you annualize it for every year over the past 4 years, you've seen that consistent revenue growth across each of their segments within the analytics business. So whether you're looking at decision solutions, research and insights, or data and information across the board, you're seeing very strong, consistent growth. So it doesn't matter really if the economy is in a recession, if the economy is booming, whether it's high inflation, low inflation, high interest rates or low interest rates, the analytics business will continue to do very, very well. And you see, even in 2022, as the economy was in a bit of a tougher time, the analytics business continued to grow year over year. You saw that growth in 2023. You're once again seeing it in 2024 as well. So that's the analytics side of Moody's. The other part of their business, the investor services, is a little bit more of a give and take relationship. So the things that are good with the investor services business, for at least at the current time, is the growth rates. This business is growing nearly 41% year over year on their top line. So across the board, you're seeing growth in the investor services business, also in Moody's as a whole. The other thing you really, really like about this business at the current time is the fact that your adjusted operating margins are absolutely skyrocketing. So you went from nearly 53%, now close to 60% adjusted operating margins, just underneath 60%. And like we did with the analytics segment, I want to compare this to S&P Global's ratings business. So we took a look at this last week. S&P Global's ratings business coming at nearly 62% adjusted operating margins. That was up 6.5% year over year, growing at nearly 36% on that revenue side. Again, Moody's Investor Services growing revenue a bit faster at 41%, but your adjusted operating margins nearly not as high, still growing close to 6.4% year over year though. So all in all, the quarter held up over at Moody's, especially when you compare it to its peer like S&P Global. One thing I would want you to keep an eye out is in future quarters, if you see the adjusted operating margins or revenues declining at a time where competitors like S&P Global are growing their revenues and margins, that's a clear indication of market share decay, at least in the company that's declining. So that's one way to kind of keep an eye on how these companies do against each other. Certainly they're very dominant and monopolistic, and they have a very large market share of the credit ratings business. But if you see weakness in one company and strength in the other, that's a clear indication that at least the company that's not doing nearly as well is losing market share. The other thing the investor services business does is they highlight some headwinds and tailwinds for the upcoming full year. In fact, for the underpinning 2024 full year. So a lot of this has passed as we're now currently in Q4 of 2024. That should probably get reported relatively soon. So they will likely release a macroeconomic assumptions for the fiscal 2025. But at least in 2024, we got some tailwinds, mainly that the central banks continue to cut rates as inflation eases. So this is probably the most important tailwind for any credit ratings business, let alone Moody's and S&P Global, which dominate nearly 80% of the total credit ratings market share. And so as interest rates begin to come down, more and more companies will likely continue to take on more debt, and especially certainly refinance existing debt to possibly get lower interest rates on it. And so they'll need that debt to be rated by agencies like Moody. You also will likely see a pick back up in M&A activity into 2025. And so those M&As require debt financing. Again, likely that debt will be credit rated by a company like Moody. So especially lowering of interest rates and a pick back up in M&A activity, likely good signs for Moody's and S&P Global moving into the near future. Now, the one thing I would highlight with the investor services business is the fact that it is a little bit more cyclical, especially compared to the analytics business, which, like we saw, is very steady as a rock despite what the economy is really doing. You won't see that with the investor services business. Again, it's a credit ratings business, so you're more dependent on rates, you're more dependent on the economy and how corporates are willing to finance and refinance parts of their debt. And so that's why into the end of 2021 and going into 2022, you saw that year-over-year decline in your investor services revenue. You're now seeing that pick back up in 23 and then 24 as well. But again, a bit more cyclical, a bit more dependent on what the Federal Reserve does as it pertains to interest rates. So keep that in mind. You have the analytics business steady as a rock. You still have a very large investor services business, and when times are good, this business should be booming. Now, as it pertains to the future for Moody's, we take a look at the next couple of quarters for this company, and from a revenue perspective, you're expecting that nearly 8% growth in the current Q4 that they're expected to report relatively soon. But as we look into fiscal 2025, you're expecting somewhere in the low to mid single digit growth on the revenue side. So 3.8% for Q1, as high as maybe 4.5% until you get to Q4 of next year, where you expect nearly 12% revenue growth. And so for that reason, Moody's is expected to at least have relatively slow to mediocre growth on the revenue side in fiscal 2025. Similarly, on the earnings side, you're expecting basically somewhere in the mid to high single digit earnings growth. It's until you get to the fourth quarter where you expect that reacceleration in earnings per share for Moody's investors. And as we took a look at the earnings, the forward priced earnings, you're trading closer to 39 times for this company. As you look into 2025, maybe that price earnings is closer to 35 times. But again, 35 times for a company that's expected to post relatively slow earnings growth does beg into question, is the valuation at least fairly valued, if not slightly overvalued as well? Now, I do know this is a high quality company, and so part of the valuation is you're paying for a predictable, very high quality company as well. So keep that in mind. The earnings, as they begin to slow down in their growth rates, the valuation may certainly have no room for multiple expansion from the current point. Now, moving on to the technicals, this is a company that over the past, call it decade, nearly 2 decades, very strong uptrend, super easy to analyze from a technical perspective. You basically find where they tend to see support in an uptrending channel, and you basically buy that dip because it's proven time and time again to be the way to invest in companies like this. So you're basically sitting on a channel that started back in 09, at the start of 09 after the great financial crisis, and has held steady since then. Right now you're trading closer to the middle of the channel, which I dissected with this light green line. You could maybe make an argument to step in here, maybe with fractional shares, if you do expect shares to continue to grow higher and test the top end of the range. Certainly wouldn't be overly excited to do that. I would rather wait for a pullback near the bottom end of the range, closer to $420, $425. That point would trigger a buy opportunity as well. But keep in mind, you don't test the bottom end of the channel all too often, maybe just 5 or 6 times over the past 13 or 14 years. So keep that in mind. Don't get a bit too greedy with names like this, I'd say, but also keep in mind that the valuation is looking pretty fairly valued. You also are expecting slower or moderated growth in the upcoming year as the year-over-year comps begin to get tougher. But nonetheless, you're still very much in a well-defined uptrend, and you could certainly make the case to be buying any significant dips in shares of Moody. So that was my take on shares of Moody. Next up, we're taking a look at MSCI Incorporated, ticker symbol MSCI. Over the past 1 year, you've seen shares of the financial services giant underperform not just Moody's, but also the S&P 500, as shares are up just around 10% over the past 1 year. It's when you stretch out the performance over a longer period of time, 5 years, you've done fantastic if you've held shares over that period, as you're up closer to 130%. So similar to S&P Global, like we said last week, I think both of these companies, Moody's and MSCI, I'd say are more so for the long-term patient investor with sort of a Warren Buffett style of approach, where you're investing in dominant monopolistic companies with large moats. Probably not looking to trade these all too much, although with MSCI, you do possibly have a trade setup that we'll talk about when we get to the technicals. But you're looking at a company closer to $47 billion, so not quite as large as Moody's, but you do have slightly larger of a forward starting yield, close to 1.06%. And on a forward basis, you're still trading relatively in line with Moody's, nearly 40 times a forward earnings. When you annualize that for fiscal 2025, probably closer to a 35 times a forward earnings multiple. So we'll take a look at the valuation as well as it pertains to MSCI. Now, similar to Moody's, they have a couple of business segments that we'll try to make sense of. So the first and the largest business segment for MSCI is the one you probably have heard of. That is the index segment, and that provides indices for use in various areas of investment processes, including indexed financial products such as ETFs, mutual funds, futures, options, and so on. So very similar to, I'd say, the S&P Global's Dow Jones and S&P indices business. As the name suggests, MSCI is an index themselves. They also provide indices that can be used to create ETFs or performance and benchmarking across different portfolios that portfolio managers and other investors could be using. So in the case of S&P Global, the flagship index is of course the S&P 500 and the Dow Jones Industrial Average. In the case of MSCI though, you have a little bit more of thematic indices, more geographic specific. You can also create custom ETFs that are focused more so on things like climate or ESG, as those are different parts of MSCI's business. So these are just some of their indices. They have over, I believe, 280,000 indices out there, but you can look at it and make it more specific based on certain geographies or certain themes such as climate. And so you have tons of portfolio managers out there consistently benchmarking their performance of their ETFs or their portfolios against these indices, and that requires the licensing of some of these MSCI indices, for which MSCI receives a fee in return. So that's sort of that business model, very high margin. This does make up the majority of this company's revenue. Now, a smaller segment of this company's business is the analytics segment, which again offers risk management, performance attribution, portfolio management across an integrated view of risk and return services, analysis of market, credit, liquidity, and risk across different asset classes. So very similar to the Moody's analytics business, also very similar to S&P Global's market intelligence business. And so they have a ton of different solutions as it pertains to their analytics business, whether it's risk management or it's private wealth management or equity investing or different types of quant investing solutions. Whatever it is, they have a solution for that as it pertains to the analysis of market, credit, and risk. Now, the other segment is very similar, I'd say, to the analytics segment, which is their ESG and climate segment. that specifically focuses on analytics and products and services such as data and research, more specifically for ESG and climate. And so any institutions or institutional investors that are focused on those segments likely rely on that part of their business, similar to how S&P Global has a dedicated segment simply for mobility. I'd say MSCI has a segment dedicated just for ESG and climate, and then they have an all other segment which caters more so to private assets, including real estate, infrastructure, benchmarks, and other sorts of analytics. So really, if I had to classify MSCI, I would also classify it within two business segments. The first one being indices, which makes up the majority of their revenues, very high licensing fee sort of business model. And the other part I would classify as analytics, whether it's specifically for ESG or climate or private assets or credit or risk, whatever it is, I'd say it sort of falls under the analytics segment. And those make up the majority of this company. And that's, I'd say, the best way to begin understanding MSCI. Similar to Moody's, you're getting a dividend with this one. You're also getting very consistent dividend growth over the past 10 years. This company has consistently increased its dividend and relatively fast as well. As you see, back in 2020, dividend was closer to 68 cents per share on a quarterly basis. Now you're getting closer to $1.60 per share on a quarterly basis. You're growing, I'd say, close to 20% annualized over the past 5 years, which is pretty solid. And when we take a look at this company's free cash flows, you'll see they probably have no problems continuing to up that dividend in the near future. Now, MSCI, similar to Moody's and S&P Global, came in with a Q3 earnings beat, reflecting strength in their index and analytics business. They also lifted their full year free cash flow guidance for 2024. So again, you're seeing very strong earnings coming out of this whole sector from all of these companies. And so while that's good for now, they're raising guidance. It also begs the question that will guidance for fiscal 2025 be as rosy, and will the comps for next fiscal year be a bit more challenging to come in with strong double-digit growth? Now, with MSCI, I did want to point out their operating revenues mix. So the index business makes up nearly 56% of their revenues. The analytics business makes up nearly 24%. And then you have that ESG and other business making up nearly a combined 20%. The important thing with this to note, though, is nearly 97% of this company's business has recurring revenue. That is just incredible. 97% of the incoming revenues are recurring on a year-over-year basis. Nearly 70%, 74% of it is on a subscription model. So that is very, very impressive. You're also seeing this company is diversified pretty widely in terms of geographies, as half of their revenues is from Americas and nearly the other half is from Europe and Asia. So that's an exciting thing. And like we spoke about with Moody's, anytime you have recurring revenue, the important metric to keep in mind is the retention rates, because you certainly want those customers to continue to stay around and continue to provide that recurring revenue. And so this company has a very, very solid retention rate of nearly 94.2%. You see over the past, call it 4 or 5 years, it basically hasn't budged, as you've been somewhere in the 92 up to 96% range on the quarterly retention rate. So very, very impressive financial metrics from this company. And speaking of financial metrics, in terms of their balance sheet, it's not, I'd say, overly impressive. We're certainly not looking at Google or Microsoft or Amazon here, but you do have a pretty solid balance sheet nonetheless. You have nearly $500 million in just cash. You also don't have a ton in property and equipment, as it's a relatively asset-light business model. In terms of liabilities, you do have a fair amount of long-term debt, nearly $4.5 billion year over year, over the last 9 months. Did tick down just a little bit, but yeah, that $4.5 billion of long-term debt offset by just $500 million in cash. So from a balance sheet perspective, not overly great. I'd say a little bit concerning, but as we come down to the cash flows, you'll see this company is very, very good at generating positive operating cash flows. And in fact, over the last 9 months, generating nearly $1 billion, close to $1.1 billion, in fact, of positive operating cash flows. And they don't have a ton of CapEx. They have a little bit in CapEx of software development costs, but all things considered, you still, over the last 9 months, had nearly $1 billion in free cash flow. And so how do they go ahead and use that free cash flow? Well, they use about half of it to buy back or repurchase common stock, which relatively in line to last year. As last year they were on pace of buying back nearly $500 million as well. This, again, over 9 months, so you can sort of annualize it to be close to $700 million in stock buybacks for a full year. they continue to pay out more and more in dividends as they continue to up that dividend year over year. And then you see this repayment of borrowings figure, which for the last 9 months isn't crazy because you did offset that with proceeds from borrowings. But over the last quarter, you did pay off nearly $25 million of debt for this company. So this company, I believe, will continue to pay down that debt. They'll probably get pretty favorable interest rates on it. So in terms of financing activities, you have a bit of tug and pull in terms of buying back stock, paying out that dividend, and repaying debt. Now, all three of those are shareholder friendly activities. So in terms of how they use that free cash flow, that is something you as an investor in this company can absolutely be confident in. So one thing to note is the debt on the balance sheet and whether or not this company will look to pay that down aggressively over the next few quarters. Now, in terms of growth rates for MSCI, this company is expected to grow a little bit faster than Moody's. You're expecting that that high single digit, low double digit growth in fiscal 2025. As Q1, you're expecting 10%, and then you go down the line, basically expecting 9% revenue growth throughout the year. In terms of earnings growth, a little bit faster at low to mid double digit growth. As you head into Q2, you're expecting nearly 15% earnings per share growth as well. So you're expecting slightly faster growth than what you saw with Moody's. In terms of a forward earnings multiple, you're still relatively high at close to 40 times. When you factor in 2025, you're probably closer to 35 times. And so from that perspective, the valuation for MSCI looks a bit better, at least, than Moody's, because you're getting a little bit of a faster growth rate while you're still paying close to 35 times an earnings multiple. So on the surface, the valuation does look better. It's whether or not you want to be more so in the credit ratings business as Moody's is, or you would rather be in an indices business similar to, or I'd say more so, that MSCI is in. Now, with that being said, the technicals for this company look absolutely stellar. Similar to Moody's, you stretch this out over a long period of time. This company, having been public for only about 15 years now, has a very, very strong track record. And you're basically seeing the stock chart continue to just move up and to the right. And that's certainly what we like to see. And so you're on this long-term uptrend that started back in the end of 2012. And yeah, basically held intact. Now, one way you could maybe look to play a trade in MSCI is, let me bring this closer to a daily view. And really since April of 2024, you've been making a slightly steeper pattern of higher highs and higher lows. And more recently, you're now basically coming down to test that higher low support. So you're sitting right there on it at $600. You could even maybe create a channel by placing a line on the top end of it. And so if you're looking to play a swing trade with this company, which again, I wouldn't really recommend for any long investors, you probably are better off buying and holding a company like this, but certainly you do have an opportunity based on the technicals to at least attempt a swing trade. You probably set your stop loss pretty tight here at $580 a share, which is your previous set of lows back from November of 2024. And so you're risking right around $20 to the downside with the hopes that you come in here and come back and retest closer to $660 a share. So you're looking for maybe $60 in upside with the downside of close to $20. So that's one of the ways you could actually play a swing trade at the current time with MSCI, simply because the trade setup looks pretty fantastic. This uptrending channel has held strong since April of last year. But if you certainly are looking to still play the long game, you have a monster uptrend in your favor, and any significant dips, I'd say closer to the 550s, is probably your time to step in and be a buyer. And again, don't feel like you need to unload a full position anytime MSCI or any of these stocks come closer to the bottom end of this range. They are relatively expensive, closer to $600 a share. And so you could look to maybe pick up fractional shares, start building out your position in case it bounces. You at least have skin in the game, and then you continue to track it on your watch list. And dips throughout this company's history have been signs of great buying opportunities. And so you continue to buy the dip and incrementally add to your position with names like this. And with MSCI, you also have a near-term trading opportunity if you'd certainly want to play that. Now, in case you don't want to come in here and pick a winner between Moody's or MSCI, you also certainly do have the option to come in here and buy an ETF. And the one that I found to be most fitting is the iShares Brokers, Dealers, and Securities ETF, ticker symbol IAI. You're closer to $150 on this. You do get a nearly 1% dividend yield. The expense ratio isn't, I'd say, overly cheap. It's certainly no S&P 500 ETF, but you are still within 0.5% of an expense ratio, and so not overly egregious. Keep that in mind, though. You do have a 0.4% expense ratio, but your top 10 holdings include Goldman Sachs, S&P Global making up nearly 13%, Morgan Stanley also making up close to 13%. You come down, you have MSCI and Moody's making up each roughly 4.5% of this ETF. So you get nearly, I say call it a 22% exposure within just S&P Global, MSCI, and Moody's. You also with this get some traditional banks in Goldman Sachs, Morgan Stanley, Charles Schwab, and then you also get different exchanges as well. You get the Intercontinental Exchange, you also get the NASDAQ exchange, along with a crypto exchange in Coinbase. So this is actually a pretty solid ETF in case you want to get exposure to sort of the securities and exchanges sector of the financials market. And over the past 1 year, you've seen pretty strong performance, up nearly 38% with this ETF. So that was my take on Moody's, on MSCI, and along with that, an ETF in case you don't want to come in here and pick winners and losers. Out of these two companies, if I had to say, I would actually pick MSCI as a better buy today, simply because you have your valuation a little bit cheaper as compared to your growth rates. You're also getting it at a slightly higher starting yield. And then last but not least, you do have a pretty strong technical support currently at the $600 level, and then not much lower at $570. So while I think both companies are very, very strong and can make for a solid position in your portfolio at the current time, I would prefer MSCI over Moody's. And if you were to throw in S&P Global in there, I would actually prefer S&P Global over the other two altogether, simply because the business still remains a little bit more diversified. You're getting analytics, you're also getting credit ratings, and you're getting indices all within one company, as compared to Moody's and MSCI, where you're only really getting two of those three things at any given time. Let me know your thoughts on Moody's and MSCI below in the comments, which one you guys own and which one you prefer and expect to outperform in the near future. Maybe throw in S&P Global in that mix as well. Stay tuned here on the channel as Q4 earnings, we're just about 2 weeks away from all the major banks reporting their Q4 results, and then following that, we'll get all the major tech companies that we love to cover here on the channel. I'll be active throughout earnings season. I'll try to cover as many companies for you guys as I possibly can. So be sure to hit that subscribe button, hit that bell notification button so you don't miss out on a future upload. As always, thanks so much for listening, and I'll catch you guys in the next video.